Welcome back. You got 100 points plus on the Nifty, 22,600 plus right now. Well, let's take it straight to the top mines at one of the largest equity funds, actually largest mutual funds in the country. SBI Mutual Fund is what I'm talking about. And we have the top mine on the equity side, the top mine on the fixed income side with us right here in our studios. Mr. R Srinivasan is Chief Investment Officer, Equity, and Mr. Rajeev Radhakrishnan is Chief Investment Officer of Fixed Income at SBI MF. Gentlemen, good morning. Great to have both of you here. Thank you very much. You know, only half joking, but nowadays when we have something like this kind of mix and match, which is equity and debt, I recently, by the way, had this experience. The debt CIO was more bullish than the equity CIO on equities. So I don't know what's the take, broad take, thrust of it. Why don't you start?
I'm all equity, sir.
I know, but
equity.
Are you?
I'm not as bullish, obviously.
You're not as bullish.
The other guy.
So there you go. There's a start.
I may not be as negative as he is.
But really, what's the sense, Srini? I mean, are you not as bullish on mid and small caps? Are you more bullish on large caps? Is there a tilt here, or broadly you're saying that things are kind of priced to perfection?
Yeah. So I'll give you a nice objective perspective. Yeah. So we kind of avoid speculating on markets individually. Yeah. We all have our views, right? We have a nice model running on which we run a fund. And basically it looks at earnings, it looks at valuation, and it looks at sentiment. So that model currently is negative on markets, and I kind of agree with it personally also. So earnings are fine. Earnings have been, momentum has been very good this year. It'll probably continue for the next couple of years. I think you'll see 14-15% earnings growth, hopefully. The problem is, obviously, like you mentioned, valuations. So valuations, and we look at a fairly, I won't say complicated, but a measure which looks at the PE multiple. It's like, we call it the Shiller PE bond yield spread. So Shiller kind of accounts for the earnings cyclicality because it looks at 10-year inflation adjusted. And we also take out bond yields from it because bond yields have played a very important role in PEs, right? When you look at just absolute PE. Sure. And that is clearly expensive relative to history. It's somewhere around the 75th or 77th percentile.
Okay.
And then we add a sentiment variable to it. So what that sentiment variable does is it ensures that you don't sell out early when there is momentum and you don't buy early because the market tends to overshoot on the upside and on the downside. And we put these three together and it gives us, it tells us what we think about equity in terms of an objective number. So we run a fund. It's benchmarked to a 50-50 debt equity index. And currently the model says equity should be 20%. So it could go 0 if it is really negative on the markets. It could go to 100 if it is very bullish. It was at 40 last month. It's gone down to 20. So we don't, there is no gradient. And it's conscious because you don't want to increase the churn in the fund. So, yeah. So
how do you do, what the model is telling you this and you'll go with it, but what do you do about it? I mean, how do you, is there any, did you act on it?
On the fund, we do.
Yeah.
So the fund is like, the fund manager has a 10% discretion. So he's right now running 30% equity against 50% in the benchmark. And potentially when he's like way bullish, let's say the bottom of COVID, he would have been 100%.
Okay. I'll get to Rajeev in a bit, but I just wanted your view on, we were just having a discussion with Savita, who is the head of equity research at Bank of America. And she was making this point about India as to how we are moving from a low income to a middle income economy. And investors in the US are sitting up and taking notice and they're investing in, the consumer space in India, etc. Do you think this is a big theme that investors can play even here? And if yes, how do you sort of, what is the granular way to look at this?
No, it is. And let me clarify. So this is like a short-term view on the market. When I say short-term, let's say it's a 1 to 3 year view on markets. The long-term story is definitely very attractive here. I have all my money in equities and I'm very bullish on it. Right? So, but when we talk about markets, we really don't talk about the 10-year view. Yeah? We always positive.
Yeah. No, coming back to the question that I was asking on the, the consumption theme of the market, right? I mean, if you're saying you have all your money in equities, I'm sure there are some big themes that you're looking at over the next 5 to 10 years.
So aspirational consumption is something we've been bullish for a very long time, and that's something we continue to play. In fact, we're hitting the limit on a lot of the stocks that we like, right? Industrial manufacturing has been kind of on and off as a theme. The China plus one factor has played a big role in kind of bumping up that theme, right? We put out some note on China, and we think while India has benefited, it may not be as compelling as it seems.
Okay.
Yeah.
Rajeev, you want to jump in on that? I mean, what is your view on how things may play out from the RBI's front? What are you penciling in terms of rate cuts, and how do you see the economy shaping up?
Yeah, so we just had the policy review last week. So the messaging from RBI has been quite consistent, I would say, over the last 1 year. So today we are in a context where economic growth is fairly robust, and that gives the RBI enough elbow room to actually focus on their midpoint target, which is 4%. So I think the central bank being quite resolute in its policy target of 4 honestly gives a lot of confidence for a fixed income investor, because you really have to look at real returns or real yields. And if we are able to anchor inflation closer to 4, that's a significant cushion on real yields that you get as a fixed income investor today. So I think that's the broader context. So of course, in the near term, we may have some external headwinds, given that you still have this geopolitical issues that could potentially keep crude prices elevated. The more there's delay in the Fed rate reduction campaign, to that extent that there would be spillover effects in India as well. But broadly, I think from an economic perspective, a macro perspective, India is clearly well placed. And I think RBI's policy is just in sync with...
When are you expecting the first cut? October or beyond?
I wouldn't pencil in a cut from the RBI anytime soon. What is interesting to observe is, in fact, they've actually indirectly loosened policy at the margin. So if you look at from mid-August of last year onwards, the system was operating at the upper end of the policy corridor because liquidity was kept tight.
Right.
And the overnight rate was at 675. So over the last couple of months, they have actually unwound that. There has been enough government spending. RBI has infused liquidity through its operations, the FX swap that got unwound, plus the short-term repo. So they have guided the overnight rate back to 6.5, which is like an indirect, I would say, the tightening that they had instituted in August that continued till about first half of Jan, Feb, that has been unwound. So that signaling is clearly there in terms of what is the comfort on the operating rate. I think as we go forward, our projections on inflation are closely aligned in terms of what the central bank is projecting. So we think it glides gradually towards 4% over a period of time.
Okay.
So I wouldn't say they would be jumping into cut this year, but I think the overall monetary and the liquidity operation is ensure that the effective rates have actually come down in the system.
I was telling someone that sometimes the anticipation of something is better than getting it, right?
Correct.
I mean, things are good, growth is good, but there's a lollipop of a rate cut sometime
at some point in time.
So it's coming, it's there.
It should be there, I think.
Not just yet. Sheni, just to complete that loop earlier, by the way, I was surprised you said short term is 1 to 3 years, long term is 5-10, but short term is...
You want it even shorter.
Everything is happening in double quick time. I mean, but just to complete that point, are you sitting on a lot of cash? I said, are you acting on that model? You said.
Not on the active funds.
Yeah.
We typically have a leeway of anywhere between 5% to 10% cash, depending on what fund we are managing. The large cap funds have a lower leeway. The analyst fund has an even lower leeway. The mid cap and the small cap fund have up to 10% cash. So on the small cap side, we're sitting on a lot more cash. We're sitting on close to max cash, plus we also have Nifty futures, which are not exactly cash proxies, but let's say they don't winner the small cap space, right? So we're hedging that a bit. And otherwise, cash will be anywhere between 3 to 6-7%. Average cash, I don't have that number, but I'm sure it's less than 5%.
And is that in line with historical kind of averages? Slightly higher?
Yeah. There's no meaningful increase in cash because of the
on the
market
consumer side, you said you're bullish on consumer discretionary, right? Aspirational consumption. Those are the areas. So 2 questions. One, lower end on the mass side, is there any recovery going to come anytime soon? And because that's one. And second, on the investment side, what's the big thrust? Because it's been government led in a very big way. We got elections around the corner. Opinion polls are saying that the incumbents will come back once again. Is that going to be, will we see continued thrust, and will that make money from an investment theme point of view?
So the first part is kind of worrying, if you ask me, because the kind of slowdown in the hit that we've seen on discretionary consumption, especially lower down, right? It's been very, very significant. It's caught us by surprise. So a lot of these stocks that we own, they've kind of underperformed the market. We still believe in the long-term story because the story, the thesis is actually almost like a decade or 2 decades, right? And the stocks have underperformed, and I'm hoping that consumption will kind of come back, specifically on those buckets that you're talking about. Obviously, consumption on the higher end is crazy. It's going through the roof, whether it's luxury or travel, hotels, for example. Rates are going up practically every quarter, right? On investments, we are hoping there is, you will see an investment cycle kind of coming in as the economy kind of recovers. And we haven't seen, we're hoping for a recovery. It's kind of, there are signs that it's happening. And when it gathers momentum, I'm sure it will kind of be followed or kind of led by an investment cycle.
So just to take an example, right, in your SBI Magnum Mid-Cap Fund, you have 17% allocated to financial services, 16% to autos, and about 10% to capital goods. Just on an average, is that a sort of a ratio that you want to change? Would you want to allocate more to capital goods infrastructure as we approach election season?
So while we like industrials and infrastructure, we also think that they are trading slightly more expensive. So we would want to add at better prices. Having said that, the mid-cap fund is largely bottom up. So while there is a sectoral overlay, whatever overweights, underweights you see is largely of the stocks that we like, rather than, and it's also pretty heterogeneous, the sector composition. So it's very.
So if you take the focus equity fund, then which is the large cap, right, larger cap names, IT has a very low contribution. I mean,
IT has no contribution. We've never had IT services. That is Alphabet.
Okay.
So we've never had
Indian IT.
Yeah, for the last few years, IT has done well. It's done badly. We've never had.
So no
Indian
plans
IT.
To sort of you don't think
See,
IT
Focus
is
is like a bottom-up portfolio of like we have 20, 21 stocks, right? So we just pick the best ones. And IT has been a bit unappealing to me from that bottom-up perspective because we always speak of IT growth in single digits. And when you're looking of returns of 14, 15%, I think you find that elsewhere. So it's a relative thing, honestly.
What about financial services? 25-30% of the market. And
I've been very bullish on financial services. We've run a significant overweight. We've gone wrong the last year, except for the last few months. Financial services underperformed quite significantly. But I think it's a very strong thesis. One, all these guys are sitting on a lot of capital, they're sitting on excess capital. So you see the leverage passing through on ROE. So ROAs, even if they fall, ROEs might not. You are hopefully at the beginning of, or at least into the beginning of the economic cycle, and these are all pro-cyclicals.
Leverage plays,
And the most important thing is financials typically underperform when there is an asset quality cycle. They haven't lent, and I think lending standards and credit standards have improved. And it's anyway, you assume even if they haven't, the fact that they haven't lent, you're not seeing any asset quality issue at least over the next 2-3 years. So I think, and these stocks are all trading at very reasonable prices. If you look at the standard deviation vis-a-vis average, so it kind of represents, I would say, growth at a reasonable price. But we've gone wrong over the last 1 year.
Just one last question from my side. Real estate. I mean, I want your view on that because it's such an important sector because there's so many read-throughs for so many other sectors, right? An important job creation sector as well.
We are very bullish on
very
real
bullish?
estate. Yeah, we're finding it tough to play stocks because of bottom-up issues, but from a sector perspective, we're very bullish.
You think
that's
the
a very strong theme.
runway is long?
Absolutely, I think so. Long as in we're talking of like 5-7 years.
Wow. Okay. All right. We've actually run out of time, not out of questions. But thank you so much, gentlemen, for joining us.
Thank you so
and
much.
Speaking to CNBC-TV18. Well, that is the word coming in from R Srinivasan and Rajeev Radhakrishnan, or the team at SBI Mutual Fund.